I think uh, I think we can start maybe in a minute or so. I see around 12 people. Maybe a couple more people will join, but we can start in maybe a minute or so.
Sure, sure.
Shall we? Shall we start?
Start in a couple of minutes.
All right.
It to welcome our guest for today's masterclass, Dr. Ajit Kumar Singh. He's a senior officer of the Indian Revenue Service and currently serves as the Chief Commissioner of Income Tax in Delhi. He has over 3 decades of experience in tax administration and brings a rare combination of practical insight and academic depth. Previously, he's headed the Government of India's dispute resolution panel, where he has adjudicated close to 2,000 international tax disputes. He academically holds a PhD in law from NLU Delhi and an MSc in law and finance from the University of Oxford. He's also contributed significantly to scholarship in this field, including his work on the Nexus Doctrine in International Tax Law. He's also served on various committees, such as the Committee on Change Management, represented the department before the ITAT, and has argued intricate international tax matters as well. And we are very, very fortunate to have him today with us to introduce the subject of international tax. Sir, thank you for engaging with us, taking the time to engage with us, and we look forward to an enriching session.
Thank you, Prakriti, for the generous words. Good morning to all. I think there are only 14 persons, 13 only, excluding Prakriti. So I expected around 40, but let's begin. Is this screen visible? Is the screen visible?
Not yet, sir.
Not yet. Just a minute. Where is the... Just a minute. Come. आ जाओ प्रकृति है. Is it visible now? Hello. Is the screen visible?
Yes,
Yes.
yes, it is.
Okay, so this is the topic we are going to take up. And that is Introduction to International Taxation. And I have been asked to keep it basic. But before we start the proceedings, let me know how many of you are familiar with the international tax law? Anybody? Any prior exposure to this? Anybody? Am I audible?
Some are responding in the chat box. They've said no.
No. All right.
Yes, a couple of them have said no. A couple of them have said yes.
So accordingly, I'll keep it at the very basic level. So today, in next 2 hour session, we are going to cover these topics at a very basic level. The first will be the meaning of international taxation, which will include the key concepts, the domestic tax laws relating to non-residents, the historical context, and then we'll be dealing with the objectives of international taxation, which will include the fair distribution, fair allocation, the jurisdictional basis, the residence rule, the source rule, then the concept of business connection in India, the concept of nexus, the permanent establishment, the significant economic presence, and then the concept of avoiding double taxation, the types of double taxation, the methods used, double taxation avoidance agreement per se, the legal status is working, the classification, the structure, all these things we are going to look at. And then finally, we'll be dealing with the latest initiative, which is known as the BEPS initiative and the multilateral instruments which the countries have signed. And then we'll be briefly touching upon the transfer pricing mechanics. But please remember all these topics or subtopics, we can have an hour long or even longer class, and therefore don't make a mistake that they are very small topics. But here we are just introducing these topics to you so that you can have a grounding in that and you can build on that. Does it make sense to you? Keep responding. Am I audible?
Yes, sir.
Okay. So coming to this meaning of international taxation, it refers to the rules and regulation that govern how income, profits, and assets are taxed when there is a cross-border element involved in it. So when taxpayer operates in multiple tax jurisdictions, the set of rules which govern their taxation and tax allocation amongst different jurisdictions is called international taxation or international tax law. Now it addresses two issues, basically. How domestic tax laws apply to non-residents earning income in the country, and how countries tax their residents' foreign income. So basically, these two key issues dominate the entire structure of international tax law. Now, coming to the history, international taxation can be traced back to the early 20th century when the League of Nations in 1920 first proposed methods of international coordination of tax policy for two objectives. One, ensuring fair distribution of tax revenue among countries, and two, avoiding double taxation. Later, legal framework of international taxation evolved significantly, particularly through the work of OECD and the UN, and more objectives were added to it. For example, now we study measures of preventing tax evasion, ensuring fairness in taxation, and facilitating cross-border economic activities. Now, for the purpose of fair distribution of tax, countries employ two kinds of jurisdictional bases. The first one is known as the residence rule or the residence-based taxation, and the second one is the source-based taxation or the source rule. Now, under the residence rule, a country taxes the worldwide income of its residents. So if an Indian citizen is earning income in US and also in India, then his entire income, both Indian income and the US income, will be clubbed together and brought to tax under the residence rule. Under the source rule, a country taxes income that originates from within its borders because the source of income is lying in that country. This is known as the source rule or the nexus rule. Is it clear? Now, remember, no country follows exclusively residence-based taxation or source-based criteria. It is generally a mixed approach, which means there's a residency for some categories of income and source for some other types. In India, for a resident taxpayer, income for tax purposes is defined as total income derived from any source received by or accruing or arising to him worldwide, as I said earlier. So, for a resident, his worldwide income will be taxed in India. In case of a non-resident, it is only the income received by him or accruing or arising to him in India, which will be brought to tax. And the concept of income received or accrued or arising, it includes income deemed to have been received. Means the agreement has taken but has not been received. It is supposed to be deemed to be. All these concepts have been defined in section 5 of the old act and section 5 of again the new act. You know, a new act has come into operation since 1st April 2026. So both the sections are similarly numbered. So I'll indicate wherever it is necessary. Now, for the purposes of residence-based taxation, residency criteria for various kinds of taxpayers, like individual, companies, partnership, are clearly defined in the domestic law of each country. In India, it is Section 6 of 1961 Act, and same section again for 2025 Act. Now, in the case of an individual is considered resident in India if he satisfies any one of the following conditions. Not all, but any one. If he resides in India for a minimum period of 182 days in any tax year. So if it is 181 days, then he is not resident in India. Second rule is that if he resides in India for a minimum of 60 days in tax year, and in the preceding tax year, if he has stayed in India for 365 days. So these two conditions must satisfy to make him resident. But remember, this rule 2 will not apply if the individual is a citizen of India and he lives in India in that year for the purpose of employment. So if an Indian citizen goes out for employment, this rule 2 will not apply. Or as a crew member of an Indian ship, if he lives in India, then also this rule will not apply. And secondly, a citizen of India or a person of Indian origin, we'll call it PIO, comes on a visit to India during that year. So in these 3 categories, rule 2 will not apply, which means that we have to consider not 60 days in their cases, but in 182 days again. So rule 1 will come into operation if rule 2 is not applying. Now the third rule is that if the total income of an Indian citizen or a PIO, excluding his foreign source income, if it exceeds rupees 15 lakh during that year, then the requirement of a minimum stay of 182 days gets reduced to 120 days. So if he has stayed for 120 days or more, then he is an Indian citizen if his income exceeds 15 lakh, excluding his foreign source income. And finally, we have the deemed residency rule, which was introduced in Finance Act 2020, which says that an Indian citizen earning total income of more than rupees 15 lakhs, excluding foreign source income, shall be deemed to be resident in India if he is not liable to pay tax in any country. So if your income exceeds 15 lakh and you are not liable to tax, you have arranged your affairs in such a manner that you are not liable to be taxed anywhere, then you will be considered to be a citizen within the meaning of these provisions. This amendment aims at taxing high net worth Indian citizens who have been arranging their affairs in such a manner as to avoid paying taxes in any other country. So these are the rules about individual. In the case of HUF, partnership firm, other AOPs, they shall be resident in India in any tax year, except when the control and management of his affair is situated wholly outside India. So unless the control and management of their affairs are wholly situated outside India, they are considered resident in India. Fairly simple rule. Now, in the case of resident status, we have further classification. It's called resident and ordinarily resident, which applies to individual and HUF, and resident but not ordinary resident. So these two categories, they apply only to individual and HUF. An individual or HUF is said to be an RNOR, that is resident but not ordinarily resident, if any of the following conditions are met. First, if he has been non-resident in India in 9 out of 10 tax years immediately preceding the relevant tax year. So in the past 10 years, out of 10 years, in 9 years he has not been resident, he has been non-resident, then he will be considered RNOR, not ordinarily resident. In the case of HUF, the manager will have to be seen whether he has stayed in India or not for 9 years. Secondly, he has been in India for a minimum period of 729 days in aggregate in the 7 tax years immediately preceding the relevant year. So these 2 provisions are common for individual and HUF. The remaining 2 are only for individuals. It says that an Indian citizen or a PIO, if his total income excluding income from foreign sources exceeds 15 lakhs during the tax year, and he has been in India for a period of 120 days or more, but less than 182 days, then he will also be considered a RNOR, not ordinarily resident. And finally, a citizen of India who is deemed to be an Indian resident under the deeming provision which was introduced in 2020, then he will be considered ordinarily not a resident. So these 4 conditions you have to examine, and if these conditions are not met, then the resident individual will be considered ROR. Now, some important points to note. There is same residency criteria for citizens and alien. So alien and citizen have to be seen alike. But RNOR, resident but not ordinarily resident, it introduces some special rules for citizens and PIO. Any income of a non-resident or resident but not ordinarily resident, so they are at par. A non-resident is at par with RNOR, that is, and if his income is earned outside India, he cannot be taxed in India except where income so earned is from any business controlled in India or any profession set up in India. This special status is accorded to confer some advantages on the returning NRIs, as an RNOR, like non-residents, is required to pay tax in India only on his Indian source. So this is a kind of relief to the people who are coming to India. Now, residency rule for company earlier, before 2016, the provision was that a company incorporated outside India was considered resident in India only if the control and management of its affairs was situated wholly in India. Now, this phrasing situated wholly in India was problematic, and these rules were prone to abuse, as companies could claim a part of their affairs being managed outside India, and they could skip the provisions. So to block that, the provisions were amended in 2016, which introduced what is known as the POEM rule, under which a company incorporated outside India is considered resident in India if its place of effective management, POEM, is in India. And place of effective management is defined as a place where the key management and the commercial decisions that are necessary for the conduct of a business or an entity as a whole are in substance made. So unless the key management and the commercial decisions are taken in India, it will be out of the net. And to mitigate what constitutes like the exact meaning of POEM, to mitigate interpretive uncertainty, CBDT has issued a detailed guiding principles for the determination of the POEM, and that is there in circular number 6 of 2017, dated 24 January 2017. We have the link for that circular. If you want to have a look, you can just go there and have a look. There are detailed guidelines on that. Now, coming to source-based taxation, varying criteria for various kinds of incomes are spelled out in the domestic law of each country. We have section 9 of 1961 Act, and again the same section for 2025 Act. And these provisions are, of course, subject to the tax treaties, which we will be dealing with in a short while from now. Now, coming to the broad rules for source taxation, the first thumb rule is that the income accruing or arising directly or indirectly through or from any asset or source of income in India. So if any asset or source of income is in India, that shall be deemed to accrue or arise in India, meaning that will be taxable in India. In the case of property, the property is situated in India, it will be arising in India and it will be taxable in India. That's the meaning, to put it simply. Now, if there is any business connection in India, and we'll deal with this concept what business connection means, then the income will be accruing or arising in India subject to Indian tax law. In the case of transfer of capital asset situated in India will also be taxable in India. Now, look at this item B, any property in India. So what kind of income can be from the property of India? Mostly the rental income and the transfer of property, which is covered by D. So we'll not include that there. So this is the general rule. Now coming to the specific rules, salary income will be taxable in India if it is earned in India. That's the rule number 1. If it is by way of any income payable for services rendered in India. So if services are being rendered in India, then the salary paid on that will be taxable in India. And the second part of it is says that the rest period or the leave period, which is preceded or succeeded by services rendered in India and forms part of the service contract of employment, shall also be taxable in India. So a person has taken leave for some period, and before that and after that there are services rendered in India, which is part of the service contract. In that case also the salary income will be taxable in India. Now, third rule is that if salary is paid by the government to an Indian citizen for services rendered outside India, then that will also be taxable in India. And this is for that embassy employees, ambassadors who are working abroad and the salary is being paid by government of India. So all these salaries will be taxable in India. So that is about salary income. In the case of dividend, the provision is very simple, that dividend paid by an Indian company outside India shall be deemed to accrue or arise in India. So even if Indian company is paying dividend outside India, it has to be brought to tax in India, no doubt about that. Now, interest income shall be deemed to accrue or rise in India if it is payable by the government. So if the government is paying you interest on something, some debt or whatever, then that is taxable in India. Interest paid by a resident will be taxable in India, except where the corresponding debt is used for a business or profession outside India or for making or earning of any income from any source outside India. So this is one exception. Otherwise, all interest paid by a resident will be taxable in India. In the case of non-resident, the rule is that if the corresponding debt is used for the purposes of business or profession in India, then even an interest paid by a non-resident will be taxable in India. Just a minute. Is it clear to now? Can anybody just say yes or no? Are you guys there or vanished?
Yes, sir, you're audible. People are responding on the chat.
Chat work, I'm not able to see that where it is.
They're responding
right.
yes.
So coming to royalty income shall be taxable in India if it is payable by the government, again, similar provision like interest. And if it is paid by a resident, except where the corresponding right, property or information on which this royalty is being paid is used for the purposes of business or profession outside India or making of any income from any source outside India. Only in that case, the resident payment made by a resident will be excluded. Otherwise, all payments of royalty by a resident will be taxable in India. In case of non-resident, conversely, if the corresponding right, property, information, services, etc. is used for the purposes of a business or profession in India or making or earning of any income from any source in India, that will be taxable in India. For FTS also same rule. If it is paid by the government in resident, except where resident is utilizing those services in his business or profession outside India or using it in earning of any income from any source outside India, then it will be excluded. And a payment by non-resident, if it is payable for any business or profession in India for earning any income from any source in India, then it will also be taxable in India. There are detailed definition of what constitutes an FTS and what constitutes a royalty in the domestic law as well as treaty. So we'll deal with it as we go along. Now, in Rule 1, we learned about business connection, that if you have a business connection in India, then you will be taxable in India. Your income is deemed to accrue or rise in India. Now, business connection in India includes any business carried out in India in the case of which all or part of operations are carried out in India. So any part is being carried out in India, then you have a business connection in India. And second, if you have a significant economic presence in India. It's a new concept incorporated in the domestic law in pursuance of the BEPS initiative, Base Erosion and Profit Sharing initiative. And this our domestic law has been amended, and this concept has been incorporated therein. So, and what is significant economic presence will come to. Now, in the context of business connection, this concept permanent establishment comes very often, and it is crucial in determining countries' right to tax a foreign company's income. A PE, or a permanent establishment, typically refers to a fixed place of business, such as an office, factory, construction site, through which a foreign company conducts its business and activities. So if you have any fixed place, you will be considered to be having a permanent establishment. And if a foreign company has a permanent establishment in a country, the country has a right to tax the profits which are attributable to that PE. So only attributable part will be taxable and not the entire business profit. So whatever profit can be attributed to that permanent establishment, only that aspect is taxable and not the entire profit. So that you have to bear in mind. Now, OECD Model Tax Convention also defines PE as a fixed place of business through which the business of an enterprise is wholly or partly carried on. It's just I'm telling you to compare, because OECD model will be dealing with separately. Now, however, recent developments in digital economy have challenged this fixed place definition of the permanent establishment. Companies can now engage in significant economic activities in a country without having a physical presence. In response, the OECD has proposed updates to the definition of PE to include a significant economic presence in the BEPS Action 1 report. Now, what is a significant economic presence? It varies from country to country. Under Indian law, a non-resident shall have an SEP in India where there is a transaction in respect of any goods, services, or property, including the provision of download of data or software, if the aggregate of payments arising from such transaction exceeds certain threshold. In India, this threshold is rupees 2 crore. So if you have received a payment of rupees 2 crores or more, then you have a significant economic presence in India. And second aspect is that if you are soliciting business activities and engaging in users, Indian users, and the number of users exceed 3 lakhs, then also you have a significant economic presence. So just these two aspects are to be looked at for ensuring a SEP. So that covers our domestic law provisions broadly. Now coming to double taxation, this is key to all international law provisions. Double taxation occurs when two countries impose tax on the same income or asset. For instance, a company might be taxed in its country of residence and also in the country where it generates income, leading to a higher overall tax burden. The goal of international tax law is to fix this menace. Now, double taxation is of two types: juridical double taxation and economic double taxation. Now, what is juridical double taxation? Juridical double taxation occurs when the same person is taxed on the same income by two countries, residence as well as source country. Now, this occurs obviously due to the overlapping tax jurisdictions, often involving a resident of a country earning income in country B. Now, look at this illustration. An Indian resident earns in royalties from a company in the USA. Now, USA taxes the royalty income on the basis of source rule, and India will tax it on a worldwide income in terms of its residence rule. So there is a juridical double taxation here. Economic double taxation occurs when the same income is taxed in the hands of two different persons, which means the same economic activity is being taxed twice. Now, illustration again that you have to see when corporate profits are taxed and then dividends are taxed again upon distribution to the shareholders, we have an economic double taxation. Now, this double taxation has a crippling effect on international trade as it reduces net investments, returns, and significantly reduces the profitability of cross-border activities. To address this, countries enter into tax treaties which allocate taxing rights between them. And how do they do that? So these are some of the methods of avoiding double taxation. The first method is exemption method. Under this method, a country may exempt foreign source income altogether, ensuring that it is only taxed in the source country and not in the residence country. So this will completely exclude the income. In credit method, that it allows the taxpayer to offset taxes paid in the foreign country, for which the residence country will give an FTC or foreign tax credit. So you get the credit for that, whatever taxes you have paid outside. And third is the deduction method. Here, the entire tax paid outside will be it will be deducted from your income. And this method is not very effective because it only reduces the taxable base and not the actual tax amount. This is like any other expenditure if the deduction is given, which is not very effective. There are other methods also, tax sparring, but that will be beyond the scope of this session. Now coming to these DTAAs, double taxation avoidance agreements. Let's look at the legal status. DTAA, we'll call it treaty, is entered under the mandate of domestic law, Section 90 and 90 of 1961 Act and Section 159 of 2025 Act empower the central government in this regard. Under Indian law, a DTAA can be entered with any country, specified territory for granting tax relief, that is the first object, avoidance of double taxation, exchange of information for prevention of tax evasion, and for recovery of tax. So for any of these activities or all of these, the Indian government can enter into a tax treaty. Now, another important point is that India follows the dualistic theory, and therefore the agreements which need to be incorporated into the domestic law by notification. There is a monistic theory, and there is a dualistic theory. In monistic theory of international law, it says that international law is not part of the domestic law. International law is a part of the domestic law. In monism, it gets automatically incorporated into the domestic law. But dualistic theory says that no, there are two separate systems, and for incorporating the international law into domestic law, there must be a legislation. So India follows this, and therefore a notification is necessary. And without such notification, agreements cannot be implemented. Now, if domestic law does not impose any tax liability, treaty cannot impose it. So you cannot say that we are going to tax under this treaty. No tax liability can be imposed under a treaty. It is only under the domestic law. And a treaty can only give relief if the municipal legislation imposes a liability. Now, in case of any conflict between tax treaty and domestic law, the treaty provisions always prevail. This is called principle of treaty override. But there are two exceptions to treaty override rule. The first is that if provisions of domestic law are more beneficial to the taxpayer, he can choose the provisions of domestic law. And in the case, secondly, GAR provisions of Chapter 11, they prevail over the treaty provisions. The treaty, therefore, cannot protect an agreement declared impermissible under the GAR provisions. So, but for these two exceptions, the treaty principles prevail. In case of a country with which India has no treaty, foreign tax credit is allowed in respect of income accruing or arising outside India. This is Section 91 and 160. So even if it's a non-treaty country, the FTC is allowable as per our domestic law to keep them at par, to ensure non-discrimination. Now, this is the Vienna Convention on the Law of the Treaties. Everybody must have heard. This applies to all international treaties, including tax treaties. Article 26 says that every treaty in force is binding upon the parties to it and must be performed by them in good faith. Internal law cannot be invoked to justify failure to perform the treaty obligation. All pacta sunt servanda. And Article 28, treaties do not apply to act or fact which took place prior to the entry into force of the relevant tax treaty. So these are some of the important provisions. A growing number of international courts of decisions, they refer to the rules in the Vienna Convention. India is not a signatory to Vienna Convention, but it follows the Vienna Convention as part of its customary law. Now, DTA is of two types. One is called bilateral, which is always between two countries. And the other type of treaty is called multilateral, between more than two or a group of countries. There is another classification which says comprehensive and limited. A comprehensive DTA contains rules which allocate tax jurisdiction for almost all types of incomes. Limited DTA contains rules for only certain types of incomes like inheritance, gift, shipping, and air transport, estates, etc. So these are these terms will come across every now and then: bilateral, multilateral, comprehensive, limited. So that's why this was important. Now, coming to tax treaty model, these models provide the structure or a template for countries to frame their treaty. We have 4 models, but the most important is the OECD model convention, which is backed by almost all the countries. It favors residence taxation. And then the United Nations model convention, it is almost based on the OECD model, but it focuses on double taxation between developed and developing countries. It allows greater source country taxation. So while OECD model is based in favor of regional taxation, UN model convention is favoring source country taxation than the OECD model to greater extent. US model convention, not very important. It basically is the baseline for US treaty negotiations, and the prioritizing US taxing rights, strong limitation of benefits clause. We'll deal with this term again later. Extensive anti-avoidance provisions, unique treatment of pass-through entities. And then there is an Andean model convention, which is used by the Latin American country like Bolivia, Colombia, Chile, Ecuador, etc. Not very important. So these 2 models are very significant: the OECD model and the United Nations. Model treaties provide a standardized framework for countries to follow when imposing tax on cross-border activities. These frameworks ensure that taxation is fair, transparent, and aligned with international best practices. Now, apart from these model, we have commentaries relating to every article of the model convention, which is known as commentaries on model treaties. The OECD commentaries, starting with the 1963 edition, it has been published with a commentary to each article. The commentaries have been referred to as an aid to interpretation by the courts in many OECD countries and also in some non-OECD countries. Indian courts have also used these commentaries as an aid to interpretation. UN commentaries, again a copy of the OECD model, but there are some original commentaries here and there. Now look at the structure of the DTA. We can broadly categorize it in 5 parts. The first is the scope of provisions. Article 1, 2, 29, 30 will deal with that. Then we have definition provisions. We have elimination of double taxation provision, miscellaneous provision which relates to non-discrimination, etc. And then we have substantive provisions in respect of various items of income and other provisions. Now, Article 1 deals with persons covered. Who are covered by this treaty? It says that DTAA applies to persons who are residents of one or both of the contracting states. So it applies only to the residents of contracting states, either one or both of them. Article 2 deals with taxes covered. It says it covers income tax and surcharge only. Does not cover indirect taxes. Then we have definition section, where person has been defined to include an individual, a company, or any other body of persons. Company means any body corporate or any entity that is treated as a body corporate for tax purposes. Article 4, this gives the residency criteria. Residents of one state means any person who under the laws of that state is liable to tax therein by reason of his domicile, residence, place of management, or any other criteria of a similar nature. So residency under the treaty will have to be determined according to the domestic law of the contracting state. There should not be any doubt. So go to the domestic law, see whether the person is resident or not, and that will apply to treaties as well. In case a person is resident of two countries, both countries which are contracting, in the case of individual, then we use the tiebreaker rule, which we'll be dealing in the next slide. In any other case, the place of effective management determines the residency. Now, what is tiebreaker rule? It applies if a person is resident in both states, then we use this tiebreaker rule. For individuals, we have 4 rules. Permanent home in that sequence. Check where the permanent home of the person is, or where his center of vital interest situated, or if that doesn't solve the problem, go to the habitual abode where he lives. There is his habitual abode. If that also does not solve, then go by nationality. And if that is also not helping, then go to rule 4. By mutual agreement, the competent authority of the contracting states can decide where that person will be considered resident. For other than individual cases, a person is resident of a state where place of effective management is situated. And OECD commentary say that place where key management and commercial decisions that are necessary for the conduct of business are in substance made. That will be considered the place of effective management. And an entity may have more than one place of management, but it can have only one place of effective management. So there is no doubt about that. BPS action plan and the MLI, multilateral instrument, they provide to resolve tie breaking by competent authorities for other than individuals. They said in the case of persons other than individual, the 2 countries must sit and decide together. So this is the recommendation. But the existing law I have already stated. Now, Article 5 of the treaty deals with the permanent establishment. It determines the contracting state's right to tax the earnings of the enterprise of another contracting state. And Article 7 gives the law on that. It says that other contracting states cannot tax the profits of a business carried on by an enterprise of another contracting state unless such enterprise conducts its operations through a PE in other contracting states. The profits are only taxable to the extent they are attributable to the PE. This is a very important concept, that you cannot tax the entire profit. It's only the profit which can be reasonably attributed to the PE. This is called the attribution rule, which can be reasonably attributed to the PE, that can alone be taxed in the country. Now, there are 4 types of PE envisaged in the treaty. This is called fixed place of PE, first one. Fixed place PE, agency PE, construction or installation PE, and service PE. Fixed place PE, as the name suggests, is a fixed place of business through which the company or enterprise is wholly or partly carrying on its business, such as a place of management, a branch, an office, a factory, a workshop, a mine, an oil or gas well quarry, or any other area to extract natural resources. This is fairly simple concept, but there is some exclusion in this. The following business activities will not constitute a PE if they are preparatory or auxiliary in nature. The use of facilities solely for the storage, display, or delivery of the enterprise's goods or merchandise. If a facility is being used only for storage, display, and delivery, then that fixed place will not constitute a PE. This is an exception. Again, so the second exception is that maintenance of a stock of the enterprise's goods or merchandise solely for the storage, display, or delivery, that will also be excluded. Maintenance of a stock of the enterprise goods or merchandise solely for the processing by another enterprise will also be excluded. Maintenance of a fixed place of business solely for purchasing the merchandise or goods or collecting information for the enterprise, that will also be excluded. And the maintenance of a fixed place of business solely for carrying out any other activity of that enterprise, and the maintenance of a fixed place of business is solely for the combination of any of the activities above mentioned. So either singularly or taken together, if they are only for the purpose of storage, processing, delivery, etc., then they will not constitute a PE. These exclusions will not apply. Now, this is again a development from BEPS to plug the loophole. These exclusions will not apply if the enterprise or a closely related enterprise carries on the activity at the same or another place in the contracting state, and if that place or other place is a PE for the latter. So what they generally the countries used to do, they used to have a PE and then they used to have a storage facility. So if you have a PE, then even those exclusions will be included as part of your activities for the purposes of taxing your income. Secondly, if the overall activity from the combination of activities undertaken by the two enterprises in the same place or two different places is not preparatory or auxiliary in nature. This is known as anti-fragmentation rule. We will come to again in a short while. So these are some of the recent developments. Now the second category of PE is agency PE or dependent agent PE. The rule says that if a person is working on behalf of a business entity under certain conditions specified, it would constitute a dependent agent PE of the enterprise, even in the absence of a fixed place. So you have no fixed place, but you have a person working for you there, and he is your dependent agent. And dependent agent is defined as a person acting in a contracting state on behalf of a foreign enterprise, and acting as such, she routinely signs contracts, routinely plays the main role in concluding the contracts that are routinely signed without any significant changes by the enterprise. These contracts could be in the name of the enterprise, and they could be for the transfer of ownership of the property, for the transfer of the right to use the property owned by that enterprise, or the enterprise has the right to use the property, and for the provisions of services, etc. For any of these purposes, if the person is signing contracts regularly without the authority from the principal, then he is your independent agent. He is your dependent agent, and therefore he will be considered as a PE. Contrary to this, if an independent agent is acting for the enterprise in the ordinary course of that business, then he is not a PE, except an independent agent is acting exclusively on behalf of one or more persons. So if a person is independent, he can be considered PE only if he is acting only for one person or a group of persons who are closely related. So this is again a BEPS development, this last part on this slide. Now the third category is the construction or the installation PE. So a building site is a PE. A building site construction or installation project, they constitute a PE if they last for more than 12 months in a particular contracting state. So if their duration, this temporal threshold is provided, if they stay there for 12 months, that activity goes on for 12 months and more, then there is a construction PE, and then the profits attributable to that PE will be taxable in India. Any such site or project includes building roads, bridges, canals, renovation of buildings, roads, bridges, channels that involve more than just maintenance or renovating, the laying of pipes, digging or dredging. They are all illustrations for construction or installation PE. And then we come to service PE. A service PE is created when a foreign enterprise provides services through employees or personnel for a specific duration. And this duration could be from 90 days to 183 days. Most of the Indian treaties have this 90 days temporal threshold. So if the person or employee has stayed in India for say 90 days in some treaty, 182 days in some other treaty, then it will be considered a service PE. This comes from the UN model, but the OECD community, especially the 2025 updates, address it as follows. A service PE arises when a non-resident enterprise provides service in a source country through employees or personnel for a prolonged period, creating a taxable presence. So in fact, initially the OECD model was not in favor of a service PE. UN model recommended it, and Indian law has accepted this part. These substantive provisions of DTA, we have provisions relating to immovable property, business income, dividend interest, royalties, FTS, independent personal services, dependent personal services, capital gains, and other income. Now, Article 6 of the treaty deals with income from immovable property. Primary right to tax has been provided to the state where the property is situated. So if the property is situated in India, it will be taxable in India on the lines of the domestic law. So this is the model structure. Article 7 deals with the business profits. It says that business profits of an enterprise is taxable in the state of residence unless it carries on business in other state through a PE. And if it carries on business in other states through a PE, profits may be taxed in that state only to the extent attributable to the PE. Deduction of allocable head office expenses, it can be allowed subject to the provisions of the domestic law. So if the domestic law of the country permits allowance of head office expenses which are expended in the head office, then that will be allowed, otherwise it will not be allowed. Deduction income for royalty, commission, management services, interest on money lent, it is not to be considered in computing the business profit. So these aspects have to be excluded when you are computing business profits. Then comes the force of attraction rule, which is very important, and this again comes from the UN model. It says that if the enterprise sells goods or merchandise which are similar to those sold through the PE, so directly from its head office in the country, or carries on other business activities which are same or of similar kind, then such profits would also be attributable to the state of PE. This is called the force of attraction rule, meaning that a person has a PE, he's doing some business activities from there, and if he's doing the similar business activity directly from the head office in that country, then the entire profit will have to be taken together, and that will get attracted by the force of attraction rule to the PE. So while attributing, we have to consider that profit also. This is known as the force of attraction rule. Now, provisions relating to dividend, interest, royalties, and FTS. Article 10, 11, and 12 generally. These numberings are not important. It varies from country to country, depending on the number of provisions they incorporate. But these are broad articles, indicative only. Taxable on a gross basis. All these incomes are taxable on a gross basis. But if it is attributable to a PE, then it shall be taxable on a net basis as business profits. Source rules under these articles restricted than under the domestic law. Now, Article 10, 11, and 12 deal with dividend, interest, royalty, fees for included services, and these are the indicative rates. The rates could be, agreed upon from 5% to 15% in the case of a dividend, 0 to 15% for interest. In the case of royalty, it could be from 0 to 15%, and for FIS, fees for included services or technical services, it will again vary from 0 to 15%. But there are some lower threshold also provided in case of, say, if the interest is being earned from a specific institution like bank or financial institution, it would be a lower rate. Likewise, in the case of royalty, if it is industrial, commercial, or scientific equipment, then the lower rate can be provided. And for services, ancillary, and subsidy to the lease of equipment, then also the countries may agree to have a lower rate. Now, royalties. Definition under the treaty is similar to that under the IT. Income Tax Act, Section 916 of the old Act and Section 96B of the new Act. Broadly, royalty refers to the payments received or receivable for the transfer of rights, usage, or right to use intangible properties such as copyrights, patents, trademarks, secret formulas, natural resources, industrial, commercial, or scientific equipment, information regarding industrial, commercial, or scientific expertise, may be received as a lump sum or based on the usage, certain percentage of sales, etc. So if the royalty can be received by way of a lump sum payment, or it can be incorporated as a percentage part of certain sales or other activities, operations. The UN model includes computer software also. Certain treaties, like the Sweden and Israel treaty, they do not have ICS equipment clause. ICS equipment is hardware and software components which are used to automate, monitor, and control industrial processes like SCADA system, programmable logic controller, distributed control system, and intelligent sensors, etc. So this is the broad provision of royalty. FTS is again, the definition in treaty is similar to that given in the Income Tax Act, Section 917 of the old Act and Section 97B of the new Act, 2025 Act. FTS means any consideration which you receive for rendering any managerial, technical, or consultancy services, including any lump sum consideration. Now, some treaties have restrictive source rule for the FTS, which provide that FTS can be taxed only if such services are ancillary and subsidiary to the application or enjoyment of right, property, or information for which royalty is received. Otherwise, it will not be taxed. So, all right. So we'll break here. We'll continue. Let's have a break for 5 minutes. 10 minutes. All right, 10 minutes. Can we resume?
Yes, sir.
Okay. So we were on this topic, FTS. The definition I was saying that is similar to what is given in our Domestic Law Income Tax Act, which is under the Section 97B of the new Act, 2025 Act. Earlier it was 917. So FTS means any consideration which we are paying for rendering any managerial, technical, or consultancy services, which includes lump sum consideration as well. Now, some treaties restrict the application of source rule for the FTS, for example, US, Canada, and United Kingdom, which provide that FTS can be taxed only if such services are ancillary and subsidiary to the application of the enjoyment of rights or the property or the information for which royalty is being received. And the second rule is that this FTS cannot be taxed unless technology is made available or the skill experience is made available to the contracting party. Now, what is the concept of make available? This is known as make available clause, which is a very important concept, which we will deal in a short while. There are certain exclusions which do not form part of the FTS, like services for the personal use of individual, or teaching, or in or by any educational institution. They are not considered part of the technical services. There are two exceptions to this rule. And then coming to the make available clause, technology will be considered made available only when a person acquiring service is enabled to apply that technology himself. So if you're just rendering services, technical services, and the person who is receiving it is not able to apply the technology on his own independently, then FTS clause will not apply. The fact that the provision of the service requires technical input by the person providing the service does not per se means that the technical knowledge, etc., have been made available to the person which has purchased the service. The use of product which embodies technology shall not per se be considered to make technology available. So the key word is that enablement. If you are enabling the recipient to apply that technology independently for future years, then it can be said that technology has been made available, and then only fees for those services will be taxable under the FTS clause, both under the domestic law, not under domestic law, but under the treaty in some cases. Now, Article 13 deals with capital gains. This is a chart which I have prepared. So if it is a transfer of immovable property, you know what is capital gain? Capital gain, when you transfer a property, whatever amount you are getting, the difference between the sale price and the purchase price will be subjected to capital gains, subject to detailed rules in this regard. It's a very comprehensive chapter. So just giving you a broad idea of what capital gains would mean. So in case of sale of immovable property, the state where the property is situated, this will be taxable there. The location of property, you have to see where it is taxable. Any property which forms part of a business property of a permanent establishment, or if you are selling the permanent establishment itself, then the state where that P is situated will be taxing it. Alienation of ships or aircraft operated by any enterprise in international traffic, or movable property pertaining to the operation of such ships or aircrafts, all this will be taxable in the state where the enterprise's place of effective management is located. In the case of shares which derive more than 50% of their value from immovable property, we have to see the location of the immovable property. It will be taxable where the property is situated. And fifth one is any other property like shares, bonds. It is the state of residence which alone is entitled to taxing that property. I hope that is clear. Now coming to independent personal services, which is Article 14, this provision has been deleted from the Model Tax Convention way back in 2000. Earlier, it referred to professional services, other activities of independent character, which were not technical in nature, and this were taxable in source state. Now, this has been abolished. Post-deletion, this scope stands merged into Article 7, which means that it will be taxed like business profit, and PE principle will apply. So if it is an independent personal service, treat it as business profits, take it under Article 7, apply the PE principle, and tax it. Now, in case of other income, now this is a residuary catch-all provision. This is that any income which is not covered in the articles will be taxed in the state of residence straight away. But this provision shall not apply if the resident of a contracting state carries on business in other contracting state through a P. So again, the P principle will be invoked if he is carrying on business through a P, and right of property in respect of which the income is paid is effectively connected with such P, then in such case also Article 7 will have to be invoked. Now, this is another very important concept called MFN clause of a treaty. And a most favored nation clause in DTA ensures that if a country offers a more favorable lower tax rate or narrower scope of taxation on dividends, interest, royalties, or FTAs to a third country who is an OECD member, the same benefit is automatically applied to an earlier treaty partner. For example, suppose there is a treaty between India and Sweden, which provides an MFN clause. Later, India signs a DTA with, say, Netherlands, with more beneficial clauses relating to royalties and FTAs. Due to MFN clause in India-Sweden treaty, this benefit will automatically be available to India-Sweden treaty, because they have a MFN clause. I hope this is clear. This promotes non-discrimination and parity among treaty partners, and this is due deference to the non-discrimination WTO rules. Now look at this clause, how it looks generally. Generally worded MFN clause in respect of dividends, interest, royalties, FTAs, payment of use of equipment, if under the convention, agreement or protocol signed after 1st September 1989 between India and a third state, which is a member of the OECD, India limits its taxation at source to a rate lower or a scope more restricted than the rate of scope provided if in this convention on the said items of income, the same rate or scope as provided for in that convention on the said items of income shall also apply under this convention. Now, MFN clause may be in the original treaty, or it can be subsequently added by way of a protocol or an additional instrument. But the protocol, if it is added, that must also be notified under the law of dualism, as held by, this is very recently held by Supreme Court in Nestle SA case, where they have held that unless if you don't notify the protocol, the MFN clause will not apply. Now, article has certain anti-abuse and anti-avoidance provision. The first one is Article 26, which provides for exchange of information to cash tax evaders. Article 9 deals with associated enterprises, the enterprises which are related. Any profits which would have accrued to one of the enterprises, but by reason of conditions in their commercial or financial relations have not so accrued, may be included in the profits of that enterprise. Okay, so if the parties are related and we have to consider their transactions. There are detailed rules, transfer pricing rules, other rules will come to that. Then corresponding adjustments, provisions exist in certain treaties. Secondary adjustment are not provided under the domestic law. What is the secondary adjustment? That once you have made the transfer pricing adjustment, which is called the primary adjustment, secondary adjustments are that any treatment of loan, bogus loan, etc., other expenditure, you cannot do that. If you once we have made the transfer pricing adjustment, that is be all and end all, and you cannot do anything further. Now, this is another important feature of a treaty, limitation of benefits clause, LOB clause. A limitation of benefits provision in a tax treaty prevents residents of third countries from inappropriately accessing tax treaty benefits, a practice known as treaty shopping. It ensures treaty benefits apply only to the residents of the contracting states with strong economic ties, such as real business activity, ownership, and public listing in the treaty country. LOB articles provide for fulfillment of certain conditions tests by resident companies in order to be eligible to claim the benefit of treaty. Now, for example, look at the India-US treaty, Article 24. The LOB clause says that there is a beneficial ownership test provided. Who are the actual owners holding more than 50% of the company shares? So this is one test, that if they are holding more than 50% of the company share, then they are beneficial owner. Base erosion test, income is not used directly or indirectly to meet liabilities outside the contracting states of the DTA. And exclusion from active activities and listed entities. So if the entities are active otherwise and they are listed, then in that case also these exclusions will not apply. So you have to see whether you have to apply these two tests, beneficial ownership test, to see whether the treaty they are actual, real, appropriate beneficiary of the treaty, or they have to be denied benefit of treaty. In India-Singapore treaty, there is an expenditure test provided. We say that a company will be deemed to be a shell company if its annual expenditure on operations in the immediately preceding 24 months from the date on which the capital gains arise is less than Singaporean dollar 2 lakh, or Indian 0.2 million, and Indian rupee of 50 lakhs in the respective state. In India-Mauritius treaty, this expenditure limit is 27 lakhs. So these are, if they have, if their expenditure is less than that, then it will not be considered a genuine resident, and in that case, the treaty benefit can be denied. Now, coming to this base erosion and profit shifting initiative. This initiative is a comprehensive framework of several countries developed by OECD and G20 countries to combat tax avoidance and ensure that profits are taxed where value is created. So this is the basic rule, that profits can only be taxed where you are creating the value, otherwise, and not by residence or any other rule. So keeping that principle in mind, the BPS action plan was launched in 2013, and it addresses a wide range of tax issues, including transfer pricing, hybrid mismatch arrangements, harmful tax practices, digital economy taxation, etc. To implement BEPS measures, the OECD developed the multilateral instruments, MLI. Now, MLI is not a separate treaty to be signed. Once you sign this treaty, it operates as an overlay to existing covered tax agreements. This means that India and Singapore have a treaty, and both of them have signed the MLI. Then their treaty, respective DTA, will stand modified to the extent provided in the MLI. You don't have to sign a separate individual bilateral treaty. Now, this MLI aims at closing loopholes in international tax rules, prevent treaty abuse like treaty shopping, and improve dispute resolution mechanisms. India is an active signatory to MLI. India has signed it, and it entered into force for India on 1st October 2019, affecting its DTA from the financial year 2021 onwards. Now, these are some of the changes made or incorporated in MLI, which has also led to the amendments in the domestic law. The one is called the principal purpose test. Now, it's according to this test, if it is reasonable to conclude that obtaining that benefit was one of the principal purposes of any arrangement or transaction that resulted directly or indirectly in that benefit, no benefit under CTA shall be granted. So if you're just a make-believe arrangement just to get the benefit of the treaty benefit will have to be denied. But there is a carve-out, there is an exception for granting such treaty benefits if availing such benefit is in accordance with the object and purpose of the arrangement. So you have to see whether that obtaining the benefit is in accordance with the object and purpose of the relevant treaty of the relevant provisions of the treaty, then the treaty benefit will be available. Otherwise, it will not be available if it is only for the sake of getting the benefits. This is first major change. All domestic laws, almost, they stand modified by that. Now, there are some changes in the concept of PE. In the case of agency PE, it says that an agent is no longer considered independent if he acts exclusively or almost exclusively on behalf of one or more closely related enterprises. There is a corresponding law in the domestic legislation, which I have already read. Redefining preparatory or auxiliary activities and anti-fragmentation rule. This rule stops companies from splitting their cohesive business operation into small, separate preparatory auxiliary activities across multiple related entities in one country to avoid a PE status. So this has also been plugged in the treaty as well as in Indian law, which I have already read. So you have to see that in a context. Third major change is the prevention of splitting of contracts. This has been done to avoid PE status by shortening the time threshold for a building site. So if you say a person has to stay here for 90 days, then what they will do for 1 month each, they will split the contract and make a smaller time threshold so that they escape from the definition of the PE. Now to plug that, It says that if a foreign enterprise has multiple contests for a small project in a host country, each lasting a short time but together exceeding the trading time threshold, a P is created. So there is no getaway now. They can't get away with this. If you have split it without any for a shorter time, same project in different parts, they have to be clubbed together and they have to be taxed accordingly. Now, the fourth change is hybrid mismatches. This is very important because it neutralizes the tax mismatches arising from differing entity classification across jurisdictions. Mismatches arise when an entity is treated taxable in one country but transparent in another country. This is known as hybrid entity, or when a payment is treated as interest in one country and dividend in another country. So they have defined, made it at par. All the mismatches have been removed. The MLI amends bilateral tax treaties to address these mismatches. And there are detailed provisions for that. We can have a separate class on that. Now, a brief introduction to transfer pricing rule. What is transfer pricing? It refers to rules and methods for pricing transactions, goods, services, or intangibles between associated enterprises, such as parent company and the subsidiary. There is a detailed definition of associated enterprises, which we will not be dealing as of now, but they are all related parties, and for general understanding, we will treat them as associated or related enterprises. Now, this is used to allocate profits across different jurisdictions. The core principle is the arm's length principle, ensuring intercompany transactions align with the market rates. What really happens, how it works? Illustration, look at this illustration given. A company of state A sells good to its subsidiary in state B. Okay, tax rate in A is 40%, tax rate in B in 30%. So what will the company do? The principal company will sell at a higher rate. So it will reduce its income where the tax rate is high and will increase the income of country B, the subsidiary, where the tax rate is low. Okay, so this is called shifting of profit. So parent company will tend to shift its profit to state B and will sell its good at a subsidiary at a low price. The tax authorities of state B therefore will have them to adjust this price according to arm's length principle so that it aligns with the market rates. Remember, approximately 60% of the global transactions are between related parties or associated enterprises, making it a major focus for tax authorities. This is a grave area of grave concern, and that's why this policy, transfer pricing policy, has been adopted by OECD, and detailed rules have been laid down. Now, what is arm's length principle? Transactions between the associated enterprises should be priced as if they occurred between unrelated parties under similar circumstances. So if A and B are associated and they have sold some product at say 20 rupees or 100 rupees, and to an independent party they have sold it for 90 rupees, then that 90 will have to be compared, and that price will have to be adopted. Now there are detailed methods of determination of ALP, section 92 to 92 CA of the old Act and section 161 to section 166 of the new Act. We have several methods. At least, mainly 5 methods are important, but there could be other methods, given by CBDT if it prescribes. The first method, and a very popular method, is known as comparable uncontrolled price or CUP method. It compares the price charged for property or services transferred in a controlled transaction to the price charged in a comparable uncontrolled transactions. So CUP can be internal, CUP can be external. Internal CUP meaning that if the company has sold to its own subsidiary, say, same product for 100 rupees and another subsidiary at 120, then that could provide an internal comparison. And tax authorities will examine and take an appropriate view. In the case of external CUP, in case of external CUP, suppose the company has sold the product to some outsider, unrelated party for 120 and to its subsidiary at 80 rupees, then that price will have to be taken into consideration. So there are both two types of CUP, internal CUP and external CUP. The second important method is resale price method, which is known as RPM. Now, in this we subtract an appropriate gross margin, which is resale price margin, because you are not adding any value, you are just reselling it. So whatever gross margin you have added, that we will subtract at the time of sale of the product to an independent enterprise. This applies mainly to the distributors of a product who merely just buy, don't create any value, and sell it. This is known as resale price method. Then we have cost plus method. This is applied to manufacturing and service providers. Here we add an appropriate cost plus markup to the costs incurred by the supplier of the property or services in controlled transactions. So in controlled transactions, whatever is payment has been made, we try to add a cost plus markup to determine the ALP. In transactional net margin method, we examine the net profit margin relative to an appropriate base like cost, sales, assets, etc., that the taxpayer realizes from a controlled transaction. And in profit split method, PSM, we identify the combined profit from controlled transaction and split it among related parties based on an economically justified basis, often reflecting the value of their contribution. So these are some of the methods. There could be a separate method as well. We can combine one or two at the time, and then we have to see which one is the most appropriate method, depending on the nature of transaction, where the price under uncontrolled circumstances can be measured. So that you have to, these are detailed procedures. It's a matter of a lot of calculation and dynamics. Now, transfer pricing rules applies to international transaction as well as certain specified domestic transactions. So don't be under the impression that transfer pricing applies only to international transaction. There is an amendment, and now it applies even to the specified domestic transactions among the related parties, the director and the company, or the principal and the subsidiary company. Now, what is an international transaction? International transaction in transfer pricing means a transaction between two or more related enterprises wherein either one or both the enterprises are non-residents. So at least one of them should be non-resident. If both of them are non-residents, then it will fall within the definition of international transaction. And non-resident means a body corporate whose control and management lies outside India. It covers the sale, lease of tangible, intangible property, provisions of services, and lending money. This is there in section 92B, which is the section 163 of 2025 Act. So this is international transaction, that whatever transaction they are incurring between two parties, at least one party should be non-resident. If both of them are there, good enough. Now, specified domestic transaction means transactions involving related parties like director, family, or companies with substantial interest, or tax holiday entities. This SDT, or specified domestic transaction rules, apply only, there is a threshold there, if the aggregate value of such transactions in a financial year exceeds 20 crore, that is 200 million. This is section 92BA of 1961 Act and section 164 of the new Act. So there is so small transactions are not covered under SDT. Only transactions exceeding 20 crore will have to be brought within the tax net. So this is, I think they should summarize. Any question? We'll answer some questions in next 10-15 minutes on any topic. If you want me to revisit some slides, then we'll do that as well.
Are there any specific questions?
Or if you want me to, deal with some slides again, then I'll go back and do that.
You can also let us know in the chat box if you have any specific questions.
So I hope it has made some sense.
I think there's one question. Could you please move to the slides on arm's length price? I think there's a
Okay.
specific question on arm's length price. Could you
Okay.
ask a specific question, Rohil?
Let me go to that slide first. Is the slide visible now?
Not yet, sir.
Not visible. Just a minute. Is it visible?
Yes, sir.
Okay. So arm's length principle demands that the transaction should be valued as if they have occurred between unrelated parties under similar circumstances. Meaning, if A is a principal company, it has sold something to sold or done any transaction with its subsidiary, then they are related parties. Now, if you have to see, you have to look for a comparable where the same principal has transacted the same product with some other party which is unrelated under similar circumstances, and then you have to determine that price and take into consideration for tax purposes. That makes sense?
Yes, sir. Got it. Thank you.
All right. Any other question? Thank you. Any other question?
So in double taxation avoidance agreement, is
Yeah.
it that only in such countries where there's an agreement, there will be a double taxation avoidance? Otherwise, they will have to pay taxes in both the countries?
See, I mean, at times, yes, but India has a provision. I told you there is a provision in Indian treaty that even there is no treaty with India, India will give FTC, foreign tax credit, for whatever taxes have been paid outside India. Section 91, which is section 164 now in the new act. So we have that provision. Other countries, some of them have it, some of them have not. So that risk is always there. For that only they enter into a tax treaty. But if you're an Indian citizen, you are safe, because then that much credit will be given to you. Suppose you have paid tax, 1 lakh tax there in the US, then you can get that credit that you have paid. That amount will be deducted from your overall tax liability. So that is a benefit, even if there is no treaty.
So it's overall tax liability, or is it from the income?
No, tax liabilities. FTC is foreign tax credit. So get the entire tax credit as if we have paid it in India. Deduction is a different matter. Deduction means it will be deducted from your income as an item of expenditure, which is not very beneficial and effective. Yeah.
Okay. Thank you, sir.
Okay. Any other question? Okay. So that's all. Shall we wind up? Prakriti?
Sure. I think if there are no other questions, I think we can.
Oh, somebody is just trying to frame the question and want to take more time, a minute or two.
Hello?
Huh.
Sorry. So I was not framing a question. I was just saying that if there is no other questions, I'd probably give a short vote of thanks to you and to Prakriti. Thank you, Dr. Ajit Kumar Singh, for taking out this time on to deliver this address to the students. It was very insightful. Thank you, Prakriti, for agreeing to moderate this session, and thank you all of the students for attending this session on this Saturday morning. If we could possibly ask the students to put on their cameras, and we can take a small screenshot so that we'll have a short memory of this session. So if some of you can put on your cameras, then we can take that screenshot. Prakriti, can you take the screenshot at some point?
Sure. Just give me 1 second, Rahul.
Yeah.
All right, I think it's done. Thank
All
you.
right. Okay, thank you, everyone.
Thank you very much.
Thank you, Dr. Ajit. And we look
Pleasure,
forward
always
to...
pleasure.
Thank you very much, sir.
Thank you, sir.
Thank you.
Thank you, sir.
Please, thank you.
Thank you, sir.
Thank you.